Learn the art of investing on Moneywise.
Welcome back to the Moneywise Podcast. This is Seetal, and today we're going to be discussing factor funds. In fact, it's a deep dive. Why do you even need factor funds and what are they? And to help us understand this area, we have someone who's highly experienced in this field. He's a successful wealth manager with a strong track record of success. He's actually also worked in all major financial centers in Asia like Singapore, Hong Kong, and Seoul. So Prateek Sinha is who we're going to welcome onto the show. Thank you so much, Prateek, and welcome to the Moneywise Podcast. How are you today?
I'm good, Seetal. Thank you for inviting me for the show and giving me an opportunity.
The pleasure is entirely ours because we get to amp up our financial awareness quotient. And today, factor funds is what you're going to help us understand. But before we get to that aspect, could you tell us about your journey in the financial industry and what's really shaped your own personal investment philosophy, Prateek?
Seetal, I started off my career in 2009 after doing my MBA from IIT Ghaziabad. I worked for about 1.5 years in India before I decided to move to Singapore to pursue a master's in wealth management. Over there, my first job was with a VC investing firm looking to invest into startups in India. And from there, I moved on to UTI Asset Management, looking after their Asia ex-Japan business. And then I moved to Edelweiss Alternatives, where I was looking after Asia ex-Japan coverage for their private credit and infrastructure funds. I was also on the investment committee of these funds. And so over the last about 10 years, I've largely been dealing with institutions who were looking to allocate money to India, whether it's in public markets or private markets, right?
This is where we dive straight into factor funds, Prateek. Tell us what these are and how they're different from traditional index funds.
A typical index fund is market cap weighted, right? So you say, okay, if a company has a certain amount of market cap, they will get that percentage of allocation in the index fund, right? But what factor investing and how it differs is that you pick stocks from that same universe, but you pick them on the basis of certain characteristics. Now, these characteristics have historically proven to generate alpha over the benchmark, right? Okay. And all these factors are based on research which has won Nobel Prize, right? So be it quality, value, momentum or low volatility investing, right? All of the researchers who did the seminal work on these factors have actually won Nobel Prize for identifying these factors and how they have generated alpha not only in India but across the globe and across time periods.
Right.
So factor investing, so if I have to sum it up, you target specific sources of risk and return, and by doing that, you are eliminating everything else and focusing on that specific characteristic of a stock which has over a long period delivered returns higher than the benchmark. Yeah. So a factor index fund would be constructed, let's say for example, if you were looking at value as a style, right? You would start by looking at stocks which are offering the highest value in terms of, let's say, the lowest price to equity, lowest price to book value, and the highest dividend yield, right? And the stocks which meet these parameters would form the universe out of, let's say, Nifty 500. You'll pick the top 50 stocks which offer these, which meet these parameters.
Right.
And therefore, you're targeting specific source of return, which is cheaper companies over a long period of time will outperform their more expensive counterparts. And that is the source or the core of how factor funds are built.
So the other question on my mind, Prateek, is that one has been hearing more of factor investing in recent times. And I'm wondering why that is the case. Is there general amped up awareness on avenues of this nature, or is it the specific advantages that factors like value, momentum, quality, size, etc. offer? And how then do they play out when you make choices like factor investing? Could you explain?
Yeah. So, Seetal, one of the major reasons why we're seeing a lot of traction in these strategies is, of course, the returns that they've delivered in the last couple of years, right? And as more and more products are becoming available, people are able to play these specific factors and the awareness is rising. However, the fundamental reason why factor investing has taken off globally is because they are able to give you specific exposure, right? For example, if you are a low risk investor but still would like to play equities, right? A low volatility strategy focusing on stocks which fall less lets you go and target the specific source of return and risk, right? Similarly, if you as an investor are bullish about the market, momentum is a fantastic way to play it. Let's take an example of the current market scenario, right? Where economic recovery is taking place in India. And now typically value investing does really well when the economic recovery, broad-based economic recovery is taking place in the market, right? Like what we are witnessing right now, corporate growth is happening, the corporate profitability is growing. The overall macroeconomic environment is suitable for industries to grow, right? And you're seeing value doing very well. So investors, when you have factor funds, you can target specific areas, unlike, let's say, for example, a passive fund or even an actively managed flexi cap fund. That's a very broad-based approach towards investing. But if somebody wants to target a specific area, these factor funds give them a low-cost way of kind of accessing the specific thing that they want to target. And I think that is causing the popularity of factor funds not only in India, but across the globe.
Fantastic. Also, if you can get into a little bit more detail of the different factors, value, momentum, quality, and size that are to be considered, and how do each of these factors play out, and how do they influence investment returns? Maybe one by one, if you can give us a quick, sort of a masterclass. Yeah.
So let's start with the simple and the most well understood factor, that is size. We have seen historically that mid and small cap have delivered higher returns than large cap. Why does it happen? Because you're taking slightly more risk when you go into a mid and small cap strategy. And therefore, over a long period of time, we have seen that mid and small cap outperform the large cap index, right? Broadly. And that is the simplest factor to play out, that size drives returns. Then let's look at the next one, quality. Quality investing says that we will buy companies which have grown their profits consistently. They have good return on equity and good return on capital employed. Their debt to equity ratios are manageable. And the idea behind this is that good quality companies will continue to grow faster than the peer who are not that well run, right? And therefore they will gain market share. They will have more power to kind of dictate prices. And that is the idea behind quality investing. So you buy, and basically a quality factor ETF or an index fund will say, okay, I am going to buy companies which meet these parameters out of my universe of, let's say, 200 stocks or 500 stocks. Right. And therefore you go and buy that specific factor which will in long term deliver you higher returns than the other factors, right? So you're basically filtering out companies from the universe based on certain characteristics that they kind of exhibit. Next, let's say look at value. The value factor basically states stocks which are available at discount to their fair price or are trading at a very low valuation compared to the market would over a period of time revert back to their mean or the average price that they've displayed over the last, say, 5-10 years, and therefore will make exceptional returns, right? And that's again something that most of the investors have done. There are value funds out there. We as investors have gone and bought stocks which have fallen a lot with the idea that they have corrected a lot and therefore they will revert back to the mean. Value investing in form of factor ETF is just trying to put this into a formalized manner where you have defined parameters and you basically pick a portfolio instead of picking individual stocks, right? 1 or 2 stocks. You say, I will pick stocks which exhibit this particular characteristic, that is low price to equity, low price to book value, high dividend yield. Right? And I'll pick up these stocks. Let's say I'll pick the top 50 or the top 30 stocks out of my universe, and they will eventually revert back towards the mean, and I will be able to make money out of it.
Right.
Right. So that is value investing. Right. Now, momentum investing is what you basically say is stocks which have done well in the past 6 to 12 months, adjusted for their volatility, will continue to do well over the next 6 to 9 months. Think of a pendulum, right? When the pendulum starts swinging from one end, does it stop at the middle or does it go towards the other extreme, right? Momentum investing is something very, very similar. A stock which has started to move upward, which has done well over the last 6 to 12 months, has a higher propensity to continue doing well for the next 6 to 12 months as well. So every 6 months you calculate, okay, which are the stocks which have done well in the last 6 to 12 months adjusted for volatility, pick the best stocks meeting this criteria. And again, after 6 months, you evaluate. Are these stocks still meeting my requirement? If those which are not will be removed and a new stocks will be added and the portfolio will continue investing like that. So if you're in a bull market where stocks are trending upward, momentum will do fantastically well because stocks which are trending up will continue trending up as the markets move up, right? And therefore, momentum investing delivers fantastic returns during a bull market. However, they will have their own challenges when a bear market comes and the stocks which have become extremely overvalued because the prices have been trending up might correct more sharper, right? But over long term, what you will see is that these returns are significantly higher than what you would get by just buying a pure index.
Pure index. Understood.
And the low volatility factor is again is kind of an anomaly. We've always heard higher the risk, higher the return, right?
Right. Yeah.
But the way low volatility works, and it has been proven across years, across markets, is that if you buy stocks which fall less in a bear market, you will eventually be able to beat the index over long term because of consistent returns that these stocks deliver, right? For example, if you look at a stock like an HUL, or let's say a Nestle or a Colgate-Palmolive or pharmaceutical companies, they are going to go 10x in 3 years or 4 years, right? But what you will see with them is that they will continue to compound gradually at 8 to 10% or 12%, whatever the number is.
Right.
And when the market's correct by, let's say, 40%, these stocks might correct by 25%. Right? I'm just giving hypothetical numbers. And therefore, over a long period of time, when you will see a portfolio has delivered much better risk-adjusted returns, and even sometimes they were even pure returns, right?
Right.
Like at least in India, we have seen that the low volatility factor index over the last 20 years has outperformed the broader index, which is the Nifty 200 or Nifty 500 or Nifty 50 by close to about 3 to 4% per annum.
Right.
Right. So it actually works by looking at the kind of returns that you're getting from it and with lower drawdown. So somebody who's risk averse might actually want to put this in place of having, let's say, a Nifty 50.
Right.
The idea behind buying a Nifty 50 is that I want stable, safe returns without the volatility that comes with investing into mid and small cap. Right? You typically put this into your portfolio and get something similar returns with probably even lower risk than what Nifty exhibits.
Yeah. And that brings me to this other, question in that case. Where do factor funds really fit in when you're looking at a diversified investment portfolio? Can they ever be core to your strategy, or are they better as complements to other instruments, vehicles?
See, it of course will depend upon your individual financial condition, and your financial advisor would be able to give you a better picture about what is the right approach. But let me explain how factor investing works, right? And see, factor investing is not just about buying factor indices, right? It's an approach towards constructing a portfolio.
Right.
You would have heard fund managers come and talk about, right, that we do quality investing, right? Some fund managers would say, so what is he doing? He'll basically say, out of my universe of 500 stocks or 1,000 stocks, I will filter my universe by certain characteristics, right? Like, for example, my ROE should be above 15%. My PAT growth should be above, say, 10% per annum, right? A couple of factors, and they will shortlist. And then he will apply his discretion on the basis of what he understands from the market and future growth and say, I'll pick these stocks, right? So in a way, this is quality investing. Look, if you come down and some investors will say, like, I want to buy companies which are trading below their fair value. Right? So they will typically be companies which are value, which are available at a discount to what the market is offering it, right? Where the true value of the company lies. So that is again factor investing. The companies, the fund managers will say we don't want to be the top performing fund, but we would like to be a consistent performer.
Right.
Right? And that is what? That is low volatility investing, right? You want to deliver consistent returns which over a long period of time will beat the market. I don't want to be at the top quartile or the bottom quartile. I am happy being in the top 2 quartiles. That's it.
Right.
That's low volatility. The fourth factor, if you look at it, right, which is momentum investing, you'll find certain fund managers which are aiming to go and beat the market year in, year out and deliver maximum returns, right?
Right.
And that again is something like momentum. They're trying to deliver the highest return possible in the market by buying stocks which are trending up. And of course, they will have their own parameters that I'll only buy companies which meet these quality parameters or something of that sort, right? So
right.
You have always been using factor investing for building your core portfolio. It was just that it was not being done using ETFs or index funds. You were using active managers, right?
Right.
So the way I can talk about is how I have built my portfolio. I have built my core portfolio using all the 4 factor indices.
Okay.
Let's say, for example, I have a portfolio of 100 rupees.
Right.
What I've done is I have taken an equal allocation to all four factors, which is quality, value, low volatility, and momentum. And that is the core 70% of my portfolio.
Mm-hmm.
This is the equity portion I'm talking about, right?
Okay.
The remaining 30% is based on how I feel which factor is going to do well. Now,
Right.
factor timing is very, very difficult, but if you do it within this reasonable amount of money, right? So I'll give you a sense of how factors play out. Typically, when the interest rates are low and it's just starting to rise, the profitability of the company is growing, the earnings growth is there, and the market valuations are very, very low. Value factor does very, very well. Because why does it do well? Because see, when the broad-based economic recovery starts, every company does well, right? So if you were very, very negative on a certain company and you were expecting it not to do well, right? The analyst estimates whether this company is done. Even if it recovers even slightly, because of the broad-based economic recovery, the prices will shoot up a lot because a lot of pessimism was built into the stock. So value investing typically does very well when you're starting off from the bottom of a bear market and the broad-based economic recovery is there. As the market recovers to its previous highs and starts trending in a bull run, like what we've been witnessing right now, momentum starts doing very well because stocks which are doing well will continue to do well because the markets are trending upward. Money starts chasing the same stocks that are doing well. And it starts to do well. As the economic recovery, as the economy matures, let's say, for example, the interest rates have now risen to a level where highly levered companies are finding it difficult to manage their loans, right?
Right.
And inflation is moving up, therefore the raw material cost is moving up, right? Now companies which are exhibiting quality and low volatility will start doing well because most of these companies will have not a very highly levered balance sheet, so interest rate won't impact them that much. Second thing what will work for them is the fact that when the markets are reaching a place where inflation is high and raw material cost is rising, only the best quality companies will be able to pass on the cost to the end customers, right? A slightly less well-run company with not a strong moat will not be able to pass on these expenses to the end consumer, right? And therefore their margins will start shrinking. Right? This is what we saw from 2018 to 20, right? Where there was a problem in terms of how things were playing out, where the economy was not growing very fast, profit growth was limited to a certain set of companies, inflation was high, and overall growth in the economy was kind of had stalled, right? We were growing at a very slow pace. And you saw companies like Asian Paints, HDFCs of the world, right? Doing fantastically well in that period. There were, if I remember correctly, there was like the Ritik stocks, right? They were doing fantastically well.
Yeah, because I remember.
Companies could do well because they could pass on the cost. And when things are a little scary, what will you do? You'll buy the best quality companies, right? You don't want to go and play in SBI. If I want to buy banking, I'll buy an HDFC. I know the loan cycles, if they turn bad, these guys will be able to handle it, right? So as the economy starts to mature and the economic recovery is a little more sporadic and certain stocks are doing well, that is when quality and low volatility starts to shine. So what I do is I'll build a core portfolio giving allocation to all four factors. By doing so, what I'm ensuring is I have companies which are best in terms of quality. I have companies which are cheapest in the market. I have companies which are trending upward. And I have companies which will defend my portfolio. Now, based on how I feel the market is going to be going forward, I will kind of go overweight on those sectors or those factors. And then I will probably, for example, and I'll keep about 20% for that. And 10% is something which I'll use. For example, let's say I'll put it into a balance advantage kind of a fund. So let's say the market's correct. I will be able to move between equity and debt allocation dynamically without having to take a call. The fund manager will do that job for me. So this is how I would use factors for building my portfolio. You could either use a pure factor-based index funds, or you could actually pick actively managed funds which are tilted towards different factors to build your, and then overweight using these indices. So up to the end investor. I hope I've made my point clear.
Yeah. While you addressed, potential risks in between while you were talking about things, I'd like to sort of sum it up over here for the benefit of our listeners. Are there any particular risks that investors should be aware of before they actually consider factor investing?
Yes. See, all the academic research that has been done, which has proven that factors deliver value over a long period of time, right? But the key point is over time, right? It is not short term.
Right.
Don't take a bet on a single factor doing well. Always combine factors to create a more diversified exposure, which will deliver you the returns. Maybe slightly lower than the pure single factor at that point in time. But if you look over a 10, 15, 20 year period, your returns will almost be at par, but will be with having much lower risk.
Understood. If there are 3 questions, not 3, maybe 2, whatever, we love our listicle format content on the Moneywise podcast. But if there were 3 questions as a newbie, I should ask myself before I say, factor based investing is for me. Factor funds, I shall do. What are these 3 questions I should ask myself?
See, one thing which is important to ask and understand is, what is the time horizon, right? That is the first and the foremost thing that you should look at. Right? You need to figure out, can you stay invested for 5 years or 7 years in a fund if it is not doing well without panicking? The second thing is, do I understand all the sources of risk, right? Because investors end up looking at the last 3-year, 5-year CAGR returns, or let's say even a 10-year CAGR return. And you see that factors have done very well in that period, and therefore I'm happy to go in. But have you seen what is the kind of drawdowns that they experienced? What was the longest period for the time for the portfolio to recover back to its fair value? Unless and until you have done this kind of a research and you've understood whether your risk profile actually matches with the risk profile of the investment, you should not just jump into it, right? For example, if your risk profile is someone who cannot see the market volatility, I would advise that irrespective of how high the returns and momentum is offering, it is not meant for you, because you will not be able to sit through the cycle. You are much better off in a factor which meets your risk profile. And therefore, the third question you should ask is, should you do it alone, or should you go and meet a financial advisor who understands these things and can explain you the pitfalls and the advantages of factor investing, right? So you need to ask, am I equipped to do it myself? And what is my time horizon that I'm looking at? And third is the factor that I'm looking to invest in matching the risk profile that I have? And I think that eventually ties down to the first question, right? Yes. The person who's going to advise you on buying these factors would be the person who would be able to evaluate these things and show it to you.
Super. This has been, I think, a great entry for us on the Moneywise podcast into factor funds. I do believe this is the first time we've discussed this topic. Could have asked for more. And thank you so much, Prateek, for walking us through an area so interesting and so here and now. Thank you so much for being here.
You're listening to Moneywise, brought to you by Bandhan Mutual Fund. The sectors, stocks mentioned herein are only for illustrative purposes and should not be construed as a recommendation. Check out the rest of our series for more insights on investment and personal finance. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.